Okay, we can we can start. So we are going to enter today in the realm of options, and the first step, as I anticipated, is to discuss a bit how the different contracts work if we concentrate mainly on stocks and bonds. Here I'm going to present quickly how the different contracts work if we take the equity and option side, equity and bond side. And the reason why it's important to clarify a bit how they work in practice is because contracts can have different characteristics that have also implications from a pricing standpoint and also as a consequence of the pricing standpoint for how their sensitivity to the different risk factors work. I will not see all possible contracts, and the ones that I'm presenting here are the ones which are traded in exchanges. So not the ones that can be done on the over-the-counter market, which can vary completely and can simply depend on what the two counterparties agreed to trade. The three contracts that I'm going to present in more detail are these three ones. The first two are relevant for the equity market and are options on single stocks and option on stock indexes, whereas the third one is the typical one for bond markets, and it is the option on the government bond future. So here is written as option on Bund futures on the German government bond, because this is the benchmark that we used also when discussing the future contract. But in general, is the option on the government bond future. You don't have options on bonds. They are only over the counter and not truly an important contract. The relevant one is the traded one, which has the future as its underlying. As you can see, just by a quick view, there are a lot of differences among the three. And I want to start in looking at each one by one to clarify better how it works. Incidentally, the typical contract on which we focus a lot, I will also do that, for a theoretical reason, on stocks, which is the European option on a non-dividend paying stock that you discussed also in the first semester, but I will also use that again, is a contract that, as you see, is not the key one in nature, because the contract of the individual stock is typically American, not European, okay? But still is a very relevant benchmark, even if it is applied only in over-the-counter markets, and so I'm going to use that as well. I'm not reducing the importance of the work you did in the first semester. So let me start from options on single stocks. First element, they are American, so they can be exercised anytime before maturity, even if, as we are going to discuss later on, there are many cases in which we can show that early exercise is not convenient, and so at least in some parts of contracts, you can say, well, formally it's American, in practice you can price that with Black-Scholes as if it were European, because early exercise can be ruled out. But this is something we are going to discuss in future classes. From the point of view of settlement, it's important to notice that it works with physical delivery. So with options on individual stocks, you have the physical delivery of the underlying. So if I buy a call on Pepsi Cola, strike $10, and at maturity I exercise the option, or before maturity I exercise the option, I get one Pepsi Cola stock and pay $10. It's paid in full and they're received in full because there is physical delivery of the underlying. As I'm going to show next, for instance, option on stock indexes instead have cash settlement. So physical delivery is often the way of settling the contract, but not always. One also relevant element that is standard for equity options is that the premium is paid up front. So it is paid at day zero. When you buy the option, you pay the premium. Incidentally, I know that if I asked suddenly, in the Black-Scholes model, do you assume that the premium is paid up front or at maturity? Some people will say, I never asked myself that. In the Black-Scholes model, the standard is the premium is paid up front. And this is the standard for all equity contracts. So that's why also their model, which has been developed for equities as the first underlying, has been valued assuming premium paid up front. One thing that is relevant here is how the margin system works. Here I am discussing options which are traded on an exchange, so with the clearinghouse. And there is the same story as for futures, in which the clearinghouse is breaking every purchase or sale of option into two separate contracts, not between A and B, but a contract between A and the clearinghouse and B. But of course, in order to survive the counterparty risk that the clearinghouse is taking, there is a margin system. However, think about what happens if you buy an option and you pay the premium immediately. For an option buyer, which is the maximum loss you can have if things go tremendously wrong? At worst, you lose exactly the premium, okay? So, given that for the buyer, the maximum loss is the premium, but you pay the premium immediately, the first day, you cannot lose any more than that, and as a consequence, in this case, you have the margin system which is called stock style. It means that the margin system for the buyer is non-existing. The buyer only pays the premium upfront, and that's it, okay? The margin system here can be applied only to the seller. It is the seller who can be potentially losing money. Imagine I sell an option at 2 today, and tomorrow the option is worth 2.40. As a seller, I would be losing 0.40, and I would have to deposit that to the clearinghouse instantaneously. Is that okay? But the margin works for the seller only. For the buyer, he paid 2, and that's it. Is it fine? Second contract, options on stock indexes. From the point of view of the type, it's mostly European, meaning, of course, the contract is either European or American. What I mean is that in most markets, option on stock indexes are only European style. In a few markets, you have also an American style version or both types. But the greatest majority of contracts is simply European. The problem is that having early exercise with an index, with the problems of borrowing an index in short position, are such that typically it's much easier to handle a contract which just can be exercised at maturity. From the point of view of settlement, the contract works with cash settlement exactly as the future. What I mean is the following. You have a payoff for the option, which is paid as the number of index points multiplied by the multiple. Let me make an example which is far easier than describing that in theory. Imagine you buy a call option with a strike of 2,000. And imagine that at maturity, the index on which you purchased the call option trades at 2040, okay? Would you exercise the option at maturity, yes or no? You have the chance to buy at 2000 something which is worth 2040. Clearly, you do exercise the option, okay? If this were a stock, you would be making 40. Here it's a stock index, so the profit for you is 40 index points, and what happens is that you get a payoff, which is 2040 minus 2000 multiplied by the multiple. So for instance, if the multiple is 10 euros, you get 400 euros. Okay, it's 40 index points multiplied 10 euros. Okay? Similarly, for instance, if I had purchased a put option strike 2000 and the final index level were 1950, so 50 index points below 2000, I would get 500 euros by the same token. Is that okay? And even here, you do not have the physical delivery of the stocks, so that you have to close the position on the cash market with a lot of transaction costs. It's just paid in cash. Pure cash settled systematically with a multiple which typically is the same multiple as the futures, but it can depend on the contract, so not necessarily always the same. Have I been clear? premium payment, again, is upfront, and as a consequence, even here, the margin system works in the same way, so it's only for the seller, same reason as before. One minor note, not super relevant, is that the maturity of these contracts is typically on the third Friday of the delivery month, so the same date as when the future matures. There is a reason for that. Given that in many cases you can have more option contracts than futures, so it's not uncommon to find options on a monthly basis and futures only quarterly. But in the quarter in which you have both the option and the future maturing, the fact that they mature in the same date creates an advantage, because if you want to hedge the position of the option, maybe you sold the call option, so you are bearish. You want to buy a bit of the underlying to hedge. You can buy directly the future, because the option is written on the index, but since it is maturing exactly when the future matures, and on the last day the future and the index would be identical, you can hedge it as if it were an option on the future, not an option on the index, which is easier for managing the position, okay? So that's why they have the small trick of having exactly the same date. But in any case, that's a minor detail. Instead, we need to spend a few more seconds on the third contract, which is the option on the Bund future, or in general, options on government bond futures. As I said, on the bond side, this is the typical one, not option on an individual bond, because typically the individual bond itself would not be that relevant. You can have these options on the over-the-counter market, but typically liquidity is super small. Here, we have a derivative written on another derivative, and some peculiarities are the following. The first one is that it's an option which is American, but priced as a European. The reason is that it's an option in which early exercise is essentially never convenient. And so even if formally it's an American option, in practice you can use the model of a European option to price it. Here I have to admit that I don't have the time to show you why early exercise here is never convenient, and especially the other reasonable question you can ask me, which is why on earth they made it American if nobody exercised it before maturity. I can only give a super quick answer, but unfortunately don't have the time to describe that in full detail. The point is that the fact of being American helps you closing the position when the option is tremendously liquid. If you want to close the position with an option, you typically have to sell the option, okay? That's the typical way in which you can do. If it's also American, you also have the chance potentially to buy or sell the underlying and sell the underlying. Given that in this market sometimes there's an option which is tremendous, which has made a lot of money, but then nobody no longer wants to trade, and it might be difficult in certain specific situations to close the position by selling, having it American is an extra value to avoid transaction cost of selling when they are too high. But if we ignore transaction costs, then early exercise would never be convenient, okay? So it's just an extra convenience for some cases of illiquidity, but in practice it is priced as if it were European. From the point of view of settlement, this contract is settled with physical delivery. The point is understanding what means physical delivery when the underlying is a future itself, which is a bit weird. Technically, what happens is the following. Remember that here we have positions of two parties against the clearinghouse. If I exercise a call option where the underlying is the future, it means that I buy the future. So if I exercise the call option, my position of being long a call option is transforming the position of being long a future contract with the clearinghouse. That's what happens. If instead I exercise a put option, my position transforms from being long a put option to being short a future contract, because the put option allows me to sell, okay? And then, of course, the clearinghouse extracts randomly one of the guys who sold the call or the put and tell to this guy, look, you have suffered the exercise, and so his position is transformed as well. So the one who is short a call option becomes short the future. The one who is short a put option becomes long the future, okay? Because of course the position, in this case, has to become being long the future. That's what happens. Now, from the point of view of premium payment, in this case, the premium is not paid upfront. So I've written here at maturity because the option is evaluated as if the premium were paid at maturity. This is an implication also from the point of view of the margin system. Why? Because while if you buy an option on a stock, you pay the premium immediately if you are the buyer, and so it's clear that you can stand the losses. If you do not pay the premium immediately, then of course you have to apply the margin system to both parties. And it's called the margin system future style. Why? Because it works exactly as for the future, with the only difference that the margin is applied to the premium of the option. Let me be clearer. Imagine you have a case in which you buy an option at a price of 2.20. So 2.20 is the market price of the option when you buy it, okay? On the German government bond future. You are not paying 2.20 today. If tomorrow the price of the option is 2.05, this implies that the option price has dropped. Who's making money here, the option buyer or the option seller? If the two negotiated the option at 220 and the day after the option trades below, the one who's making money is the seller, the one who's losing money is the buyer. The buyer is losing 0.15, and if this is the case, he has to pay a variation margin of minus 0.15. Is that okay? If tomorrow the option drops further to 190, you have to pay either 0.15 and so on and so forth. If the option goes up, then there's going to be a payment from the seller to the clearinghouse and from the clearinghouse to the buyer. Have I been clear? So that's the story. Even here, what we do is that from the point of view of pricing, we consider as if the premium were paid at maturity. The problem is that here the premium is paid at maturity or before maturity if you are the exercise, because of course since the option is American, maybe you terminate before the final maturity. Even if, as exactly for the future, we evaluate the future as if cash flows were at maturity, but we know that due to the margins, the cash flows can be anticipated. Here is the same story. Actually, you can have the difference coming in before, in other ways. Imagine you buy the option at 2.20, tomorrow the option is 2.40, and you close the position by selling, okay? If you do that, you get a profit of 0.20 immediately. You would expect that since the premium is paid at maturity, you would lock in 0.20 at maturity whose value is 0.20 discounted. This is not the case because there is the margin system in between. So actually you're getting instantaneously the profit that you should have get at maturity if you didn't have a clearinghouse. Have I been clear? But it's the same story as for the future. So from a pricing standpoint, we consider that as if cash flows were at maturity. In reality, they are anticipated on the margin system. And this can be in my favor or against me. Since I don't know as granted what's going to happen, we price it as if cash flows were at maturity. That's the intuition. Incidentally, as a very minor note, this is not relevant, it's just to understand my examples. Please take note that the maturity of this contract is 6 working days before the beginning of the delivery month. So when you see March future options, and you ask to anybody on the street, when does a March future option mature? Everybody would tell you in March. Actually, March does not refer to option, it refers to future. It means it's the option on the future maturity March, okay? But since the March future ends up trading on the 10th, delivers on the 10th of March and ends up trading on the 8th of March, the standard is that the option finished well before that. So it's 6 working days before the end of February. So the September contract matures in August, the March contract matures in February, and so on and so forth. But this is not crucial, just to understand my next examples, okay? Have I been clear? So the only elements that I wanted to point out is that contracts are pretty different among each other. And one of my small concerns is that given that in most handbooks you typically discuss options only looking at the European contract on the stock, possibly non-dividend paying and nothing else. Of course, some things can be a little different when you move from one contract to another one. So my strategy is going to be different here. I'm going to discuss, in most cases, especially when we discuss option characteristics, 2, if we want, benchmark contracts. One is represented by American options on the Bund future, or more generally on the German government, on the government bond future, which incidentally, let us remember, have a premium paid at maturity. And as a second benchmark, the contract, which is the standard one, which is European options on a single stock. And incidentally, as a premium paid upfront. The reason why I would move back and forth between these 2 contracts is twofold. On one end is to give you a bit of variety to be able to distinguish what's systematically true for every possible option contract and which are the elements on which there can be some variations. The second reason is that once you understand the basic characteristics of this contract, which I just explained, which are a bit weird. It's a future, it's a derivative on another derivative, which is a future. The premium is not paid up front as we typically have for options. Once we have understood how it works, it's even easier to understand a lot of things intuitively on this contract and then treat the other one as a variation, a slightly more complicated variation, than understanding everything first on European options on a single stock. That's why I'm moving a bit between the 2. All right, let us start. The first part on which I want to understand what happens is to discuss which are the components of an option value. Trying to understand a bit conceptually what's behind the value of the option. Of course, I could possibly start directly from pricing models, but I want to keep it a bit more intuitive and looking at the economic intuition behind the model before we are also going to work on them. And for instance, let us consider an American call option on the September Bund future, having strike price equal to 140, so K in my notation is the strike price, and with maturity August the 22nd, 2021. Here is the September contract, which matures in August, as I was discussing earlier, okay? Now, imagine you have to evaluate what is the value of the call as a function of the price of the underlying asset. So as a function of F, because in this case it's written on the future directly. So my underlying is directly a future price, okay? Now, even if we don't know anything about pricing models, let us assume this is the case. First of all, it's super simple to tell what is going to be the option value at maturity. If I jump directly at August 22nd, because clearly at maturity, the chance to buy the future at 140 is going to be exercised only when the price is over or below 140. I have the chance to buy at 140, I will do that only if the price is over 140, okay? For all the prices below 140, I will never exercise the option, so the option would expire worthless. Whereas for all the prices greater than 140, the value of the option at maturity is going to be a 45-degree line, so that, for instance, if the future traded 144, the value of the option at maturity would be just 4, okay? Here, I'm not considering the profit and loss of the position, just considering the value, okay? So imagine you got the option for free from your parents as the bonus for the first semester, okay? And only consider which is the value that you get at maturity. This is what we typically call payoff of the option. Some people call also it payout of the option. And if we wanted to write the equation of this line, it would be pretty simple. The equation of this line is simply the maximum between f minus k or 0, okay? If at maturity f is lower than k, then the payoff is 0. If the f is greater than k, that's the payoff, okay? This is pretty basic. Now, the first extra point is that for this specific contract, so for the American call on the future, this max of f minus k or 0 is not only the value at maturity, but it's also the minimum value that I have any time before maturity. So it's a value where you can never find on any possible day the premium of the option trading below that. Let me show you why in 2 seconds through a counter example. Imagine that you have the American call strike 140, and on a day in which the future trades at 142, you see that the premium of this call is equal to 1.90, okay? If it trades at 1.90, it's trading below the value that I was setting up before. So I'm saying that the value cannot be lower than max of f minus k or 0, okay? So with this situation, strike of 140, future at 142, I'm saying that the future cannot trade below 2. Sorry, the option cannot trade below 2, okay? Let us imagine it's trading 1.90. There would be a super simple arbitrage that could be made. Which kind of arbitrage? Well, intuition. Here I'm telling you that 1.90 is too low, okay? So the option has to be over or undervalued. If 190 is too low, it's undervalued, okay? If it is undervalued, the suggestion is that the arbitrage should start by buying or selling something which is undervalued. By buying, okay? So let's say we buy the call. You buy the call, and this is a cost of 1.90. And with the call, what you can do, since it is American, you can, even today, exercise the call, which implies what? If you exercise the call, 2 things happen. First, you pay 140. The second thing is you get 1 future contract, okay? So overall, you have obtained 1 future contract by paying in total 141.90, okay? Here, the 190 is paid immediately because since you exercise before maturity, you have to pay the premium instantaneously, okay? Which is the price of the future? 142. Any idea about how you can close the arbitrage? You sell the future. Okay? So the third part is that you sell the future, which means that you get 142, you no longer have the future, but at the end, you end up having a profit of 10 cents, okay? Why? Because 10 cents is exactly the underpricing of the option relative to the minimum value of 2. Is that okay? Incidentally, super quickly, by doing this thing, you are bringing the market back to equilibrium. Because clearly 190 is going to raise because you buy, the future from 142 is going to drop because you sell. Until the difference between the original 10 cents are going to become 0 and you stop doing the arbitrage. Have I been clear? All right. So this is why I call this quantity, F minus K or 0, as the intrinsic value of the call. Here I write intrinsic value in commas, and I should say perhaps my version of intrinsic value or a modified intrinsic value for a precise reason. When you talk about intrinsic value in general for options, the standard definition of intrinsic value is the maximum between S minus K or 0 for the call, or for the put option, the maximum of K minus S or 0. If you define it in this way, it is a concept that has some value for American options. Is the idea of a minimum that you can get for American options if you exercise instantaneously. But this, in this way, has no sense, for instance, for European options, okay? Because S minus K is not something I can actually realize. My version of intrinsic, my definition of intrinsic value, my sort of modified intrinsic value, is in a sense the minimum value that you can extract from an option in a given situation, okay? And here for this contract, which is the future, the option on the future, my modified intrinsic value is the maximum between F minus K or 0, because that's the value that you can extract any single day, okay? Keep in mind, if you want to feel safer, that you will never typically be asked exactly how much is the intrinsic value of the option on one desk. I need this idea just to clarify better which are the elements behind the option price behavior, and it's relevant conceptually, okay? You will never be asked to quantify that in a real life situation as if it were an important thing. It's just useful for understanding better which are the drivers of the option price. Have I been clear? Now, next step. Imagine the price of the future today is 136. So we are in a situation in which the option today cannot be exercised, okay? But imagine we have the future at 136 when we are now at February 23rd, so well before maturity, okay? Even if the option is not exercisable, if I came to you, I won't, but just theoretical example. Imagine I come to you saying, look, this is the option that you were given by your parents as a bonus for the first semester. A strike 140 option on the Boon future. Since the Boon future today is 136 and you can't exercise, would you give me the option to me as a present for free? The answer should be no, first, because this is bribing, and I will never ask for that, of course, and you will never do. Second thing, of course, you will never give the option to me because of the disappointment you have already after just 2 weeks, of course, which is also another completely understandable reason. Third element, perhaps less important than the disappointment, the fact that it was a present of your parents and it has some affective value for you in any case, okay? So apart from this kidding, the reason is economically, which is the reason why, of course, you would never give this option for free to me or to any other person in the universe. Even if today the option is non-exercisable, what's the point? We are on the 23rd of February, so there is still time to maturity, or time value, which means that there is still the chance of which possible event which would be good. What can still happen? That the future from 136 still have chances to be over 140 at maturity, okay? Now, this is correct, so there has to be a non-zero value, which is here. I'm estimating as a few centimeters up from the x-axis, okay, in my pricing model in centimeters for the time being. Extra comment, imagine today when we start the class, the future is trading at 136. When we finish the class, the future is trading 134. When we finish the class, the option price is going to be as high as now, higher or lower. If the future trades no longer 136 but 134, the option price must be lower, correct? Why? Because intuitively the chance of exercising the options are going to be smaller than they were before. There is more way to go before I trespass 140, okay? The intuition I'm giving in a super simple manner is that the option price when I'm below 140 must be somehow made in this way. There are two things which are super clear. First, it must be a monotonic function so that as I get closer to 140, the value must be larger, okay? Because there is a component which is what we call time value, not intrinsic, but time value, which is conceptually linked to the chance of future exercise that the option still has. And this chance increases as I get closer and closer and closer to 140. The more distant I am from 140, the less chances I have. The closer I get, the greater are the chances that the option can be exercised, okay? The second thing that, even if I don't know pricing models, should be clear is that this monotonic function should not be a line, but is a curve, in the sense that the reaction to an increase in the change of f is not the same when I'm close to 140 and when I'm terribly distant. Think about it. If you have the price at 138.50 and the price goes up by 1 and 139.50, so you're super close, you have a given increase in the option price. Would you have the same increase in the option price if the future trades 100 and moves to 101? No. In which of the two cases do we have a larger impact on the price? If you have a +1 when you start from 138.50 or when you start from 100? If you start from 138.50, because in this case, increasing by 1 with an option that still has some non-zero chances to be exercised is increasing them quite substantially. If you are at 100, you are so tremendously distant from having chances to exercise that moving from 101, of course, is slightly better, but is not materially changing the chance to make it, okay? It is as if you are playing football with your friends, you are losing 20-0, and you make the first score. You're losing 20-1, but this is not increasing tremendously the chance that you will eventually win the match, okay? It's different if you are losing 2-1 and you go 2-2, or 3-1 and you go to 3-2, okay? Here is basically the same story. What happens when I am on the right side of the graph? So when I'm with the price greater than 140. Here there is also time value, but it's important to understand why, because apparently one could say, look, if the future trades at 144, it's not obvious that having more time to maturity is good news, because the price can move up or down, and depending on that, I make more or less money, okay? In order to understand why there is time value for which reason, the best example I can make to make you understand the story is the following, with the key note that this is not my perception of relationship among finance peers. So it's an extreme example, not the one describing, hopefully, the situation you enjoy with your colleagues. Imagine that you got as a present from the parents a call option strike 140 on the September future. And one of the people who is in class 17 did not receive this bonus from the parents, but purchased the future at 140, okay? So he purchased the future days ago when it was at 140, and now the future is at 144. This peer of yours comes to you and tells you, look, you know what? If the future eventually closed at 144 as it is now, we would both make 4 euros because you exercise the call and buy 140 and make 4, and I purchase at 140, sell at 144 and make 4. If the future ends up at 145, we make 5. If the future goes up at 146, we make 6, and so on and so forth. At the end of 20 numbers, he tells you, so why don't we exchange our 2 positions for free, remembering the great times when we had the work group of financial valuation together in the first semester. Now, if he or she makes this proposal, apart from canceling him from any possible social network, even professional ones, for the rest of his or her life, and of course, this is not what I think is going to happen in the classroom, or even at distance in the classroom, why economically you shouldn't accept this position? Where is the difference between his position and yours? Because he could say, look, my position is working exactly in this way. I make exactly f minus k for all possible values of f that he has in the table. Where there is the difference between being forced to buy at 140 and having the option to buy at 140? When the price drops below 140 and the future does not limit my liability. So the difference between the two is that the graph of the future on the right-hand side is the blue dotted line. Unfortunately, below 140, this is the profit and loss of the future. Because he is forced to buy at 140, so if the market drops to 138, he loses 2 while you lose 0, because you simply don't exercise, okay? The reason why I make this example is that this clarifies one thing. First, the position of the guy who bought the future is 4, and your position with the option is worth more. So you'll be 4 plus something. There's an extra time value component, even here, that tells you that your position is more valuable than the future position. Second part of the story is that which is the value, the extra value that you have and your peer doesn't have? Is the opportunity, the chance to abandon the contract if the market moves against you. You have the chance to abandon the contract if the future drops below 140, essentially. The other guy is forced to buy. You only have the option to buy, which is a different story. Have I been clear? Now, if we understand that this is linked to the chance of abandoning if the market drops below 140. Last question on this. Would this opportunity to potentially abandon be worth more if the future quotes 144 or if the future quotes 140.50? In which of the two cases the risk of abandoning is larger? If the future quotes 140.50. So having the chance to leave the contract if the market drops below 140 has a lot of value when you are close to 140 and less value when you are more and more distant and the chances to abandon are close to disappear. Is that okay? This is why intuitively what you should have here on the right-hand side is a situation in which the time value component decreases as the price moves up. And so you must have a curve that for very high prices of the underlying must at the end coincide with the payoff line. Exactly as on the left-hand side, when you move here towards the left by a lot, and the future price drops to 0, eventually the curve lies on the x-axis. When you are so tremendously distant from the strike that the chances of exercising the option are virtually 0. On the right-hand side, when the chances of abandoning the option are virtually 0, the curve must be lying on the payoff line. Is that clear? Now, let me just add a bit of terminology here to be more refined, because so far I've used sophisticated concepts such as left or right. In the real life, one would talk about the option being in the money or out of the money. You're probably already very well familiar with that, but essentially you call the option out of the money when you can't extract any money from the option, so the intrinsic value is essentially 0. You have an in the money option on the other side. This is also typically abbreviated as OTM, ITM. And when you are substantially out of the money or in the money, you typically say it's deep in the money, deep out of the money. When the price and the strike are super close, the option is called to be at the money. Okay? So the option is at the money, in this case, when the future is very close to 140. As an extra component in terminology, just again to make sure you understand all the typical expressions in that, since, of course, when you talk about the price, sometimes you have the spot price, sometimes the forward price. Technically speaking, you can distinguish being at the money spot or at the money forward, in the sense that an option is at the money spot when the strike is close to the spot price. An option is at the money forward when the strike is close to the forward price. So an ST or an F is a future price depending on how you want to label that, but when the strike is close to the forward price. Keep in mind that in many cases, when you talk with a trader, he doesn't always tell you at the money spot, at the money forward. Sometimes he typically says just at the money, and you have to guess what he is meaning. In this case, the best guess that you can make depends on the type of option. Because intuitively, in most cases, especially in the case of stocks or currencies, if you have an option which is American, that you can exercise any possible moment, including now, the typical price you take as a reference is the spot or the forward, intuitively. With an American option that you can exercise even now, you take the spot. With a European option, where you can only buy or sell at a future date, the typical reference price is the forward, okay? So it's not uncommon that if you have a trader talking about with you about a European option on currencies, on the euro against the dollar, saying I'm quoting an at the money option, what he means is I'm quoting an option which has as the strike the forward exchange rate for that maturity of the euro against the dollar, not the spot, okay? In any case, check and verify before you make or lose money out of it. But on average, it's more common to think more about the money forward for European options, more about the money spot for American, roughly speaking, okay? All right. Now, quickly, what happens with the put option? Super simple. Imagine you have an American put on the September Bund future. Imagine with a strike of 135. So 135 would be the level deciding whether at maturity I exercise the put option or not. I would have a payoff equal to 0 whenever the future is greater than 135 and maturity. Here I would have a value going up with a minus 45-degree slope. And again, this slope would also be the minimum value that the American put option must have any possible date. So my modified version of intrinsic value for the put option here on the Bund future would have an equation which is the maximum between K minus F or 0. Clearly, it's not F minus K, but it's inverted, because you can sell at 135 and buy at the future price, okay? If I consider the full value of the option, including time value as well, I would have a graph working in this way, where the distance between the curve and the line is again time value. And the only part is to understand why do I have time value here. So for instance, if I have time value when the future trades 139 with an option with strike 135, time value here is motivated by the chance of future exercise or the chance of abandoning the contract with the future at 139. Is the option exercisable now? No. So it's the chance of future exercise. And the chance of abandoning the contract is below 135 when the option is potentially exercisable but can be abandoned. So here, this is linked to the chance of future exercise. Whereas here is linked to the chance of abandoning the contract. And again, on which of the sides is the option in the money? So for instance, where the future trades 139, the put option is in or out of the money? It is out of the money, because in this case, clearly there is no intrinsic value, no chance to extract any possible value. So it's out of the money here, in the money here, and again at the money when the future price is very close to 135, okay? Incidentally, a very quick thing, since it's when you have interviews or when you work in this field, it's pretty useful to be quick in basic things. One, if you have to answer in 0.1 seconds whether an option is in or out of the money, the best way, in my personal experience, is to ask yourself whether the strike price is a good price to buy if it is a call option, or a good price to sell if it is a put option. Because in this way, in 1 second, even without making graphs, you are able to answer super quickly, okay? So imagine I tell you the future trades 140. Imagine you have the call 137. Is it in the money or out? The point is 137 a good price to buy when the market trades 140? Yes. Okay, so this is in the money. If instead you had a call option strike 142, 142 would not be a good price to buy, so the option would be out, okay? If you had a put option 142, would 142 be a good price to sell if the market trades at 140? Yes. So in this case, the put option would be in the money, okay? If you reason in that way, there is no need to make graphs and potential confusion. You answer in 0.1 second and you answer correctly, okay? Perfect. All right. So this is the first step, which is understanding which are the components. So this modified version of intrinsic value plus time value. Why do we need to make this idea? Because it helps us understanding which are the factors behind that that then influence the option premium. So what I've said is the premium of the option is conceptually composed by my modified intrinsic value plus a time value component. But which are the risk factors that drive the option price up or down? Let me start from intrinsic value. In the case of the intrinsic value, when, for instance, I said that when the future trades at 144, intrinsic value is 4, how many variables have I used for that? Super simple. The price of the underlying and the strike, okay? Nothing else. With these two variables, I have defined my intrinsic value. So in this simplified case, I only have the price of the underlying and second, the strike price. Please note that these two factors also influence time value, because we have seen that the time value, both in the case in which is the chance of future exercise and in the case in which the chance of abandoning, does depend on how close the future price is to the strike. If the strike is 140 and the future is 139.5, there's a lot of chance of exercise. If the future is 100, there is far less, okay? So of course, the linkage, these two elements also impact time value. But the interesting part of the story is which are the other elements that only impact time value. Point number one, imagine, sorry. Imagine you are here with the future at 136 and you have this amount of time value that we have identified, okay? Imagine what would happen to the option price if for the next 2 days, the future remains absolutely stuck at 136. 2 days after, with the future which has not moved at all, would the option price be the same, higher, or lower? It would be lower. Why? Because the value of the option there is linked to the chance of exercising the option. That requires what? It requires the price moving from 136 to over 140. If after 2 days nothing happened, everything else being equal, you have a lower chance to trespass 140 than you had 2 days earlier. Is that okay? Similarly, imagine the future trades 144. And in the value of the option, there is also one time value component which has to do with the chances that you can potentially abandon the contract if the future drops from 144 to below 140. If you have 2 days more and the price is still at 144, the risk of abandoning is larger or smaller than it was 2 days earlier. If the price is still there, the risk of abandoning is smaller, okay? So the intuition is that even if one would say intuitively, look, you know what, I'm making money, so it must be worth more. No, the point is that if you think about conceptually, that the time value you have there is linked to the chance of abandoning the contract if things go badly, and this has not happened, that sort of insurance against the downside is worth less. So if you think about it, this curve would be going down systematically every day for any possible level of price. If the price stays where it is, the curve would tend to fall down. If you wish, the line that you see on the very last day, this line at the end, is the line on which the curve finally lies after having every day lost something, going down towards maturity. Have I been clear? Incidentally, here I'm just reasoning intuitively, but this is what you would see if you were plotting the Black-Scholes formula in a spreadsheet. Well, here not Black-Scholes exactly, because this is priced with the variant of Black-Scholes, but a Black-Scholes type model which is appropriate, changing T and changing the different prices. This is the graph, and you will say that by using T, you have the curve going down, okay? So, first element that we add here is that time must be another element, time to maturity, that enters into the time value component. And second one, element entering here is going to be the volatility of the underlying. That also is going to influence the level of time value. Why? Because intuitively, imagine if you are here at 136, if you had the news for any reason that the volatility of the future can go up, silly example, you are told that the board of the ECB is suddenly meeting because they are clearly unsatisfied with their monetary policy. And you don't know exactly what they mean. Whether they think they are going to lower rates again or to rise rates and change the position, you have no idea. The only thing that happens is that there is an expectation of greater volatility on the market. Greater volatility means that everything else being equal, the chance that the market can go up by 4 and trespassing 140, if the market is more volatile, becomes more likely. Specularly, when you are in the money, if the market becomes more volatile, the risk of abandoning grows larger. So intuitively, graphically, what happens if you have an increase in volatility? In which direction would the curve move? Please do not say left, because I should have to commit suicide, probably. Is it going up or down? If you have an increase in volatility, it goes up. Because for any possible level, you have an increase in time value on both sides. Is that okay? Instead, the decrease in volatility would mean that the curve would be moving down. Have I been clear? Incidentally, one small comment, then I will rediscuss that later on. The reason why I'm letting you spending a bit of time on this graphical view interpretation is the following. First, in many cases in professional life, you can be in conditions in which you have to explain or discuss in a meeting about options with others, and you can't say, look, let's take one day, I explain you how I derived the Black-Scholes model. Once you pass Ito's lemma, it's done, okay? With the commercial head of the bank who has probably never heard about the existence of derivatives in his life, okay? And you have to be intuitive when explaining key ideas, and this helps a lot. But on top of that, one thing on which it's important to be super quick and intuitive is understanding the partial derivatives of the option pricing formula to the different elements. And think about it. If we want to understand the derivative to sigma, to the volatility, the derivative to sigma is how strongly this curve goes up or down when you have a volatility shock. The derivative to time is how quickly the curve drops when time passes, okay? So if you think about it, you can have a decent feeling of how the derivative works, even if you don't have the formula in front of you, and even if you take a lot of time in really calculating the derivative, if you had to. Is that okay? That's why having this graphical interpretation can help a bit in finding the right answer super quickly in terms of broad intuition, okay? Incidentally, just as a super simple example about what you could do potentially, imagine you want to understand whether the price is more sensitive to volatility changes, so the derivative relative to sigma of Black-Scholes, if it is more sensitive when you are at the money or when you are completely in or completely out of the money. Think about it and look at this curve. Volatility has to do with time value, okay? And if you think about it, you have this curve moving up and down, depending on in which direction is volatility changing, but with the intuition that when you have a super low level of price or a super high level of price, time value would be zero in any case, okay? If you take a future price at 20 and the future price at 200, then time value is 0. Intuitively, if volatility changes, this implies that it fluctuates more in the middle or on the extremes. If you take a rope, if we take a rope, the two of us, and we start moving the rope, is the rope moving more in the middle or on the extremes? If we start moving, playing a bit with our hands relatively stable, moving the rope up and down, it's moving more in the middle. Here is something similar. You have a lot of impact when there is a lot of time value, so exactly close to the strike, and very little on the extremes. Intuitively, the derivative relative to sigma is much more important when the option is at the money, not when it's out or in the money, okay? I will be even more technical when we're going to discuss it, but even if you are unable to understand how the formula is, from this graph, in some reason, you can get a feeling about when this derivative is larger as opposed to lower, okay? That's why I spent some time here, and I will rediscuss that when discussing partial derivatives. So sorry about this extra work, but it's worthwhile, my personal teaching experience. All right, so next steps. What we've seen so far is what happens when I have an option on, an American option on the future. What happens if I have the second type of options we want to discuss, which is a European option on a stock? For the moment, assume we have no dividends. Then I would also see what happens if we have dividends. Essentially, what changes is that I have a more complicated version of my sort of intrinsic value. And the intuition is simple. Imagine you have a European call with a strike of 38 and maturity 6 months, so 0.5 years. And imagine the spot price of the stock is 40. Imagine we want to define which is the minimum value we could get out from the stock. Here we cannot say is 40 minus 38 for a simple reason, that I can buy or sell at 40 today, but I cannot buy or sell today at 38. Why? Because the option is European. So I can buy or sell at 38 only 6 months from now. Is that okay? The intuition here is that in order to understand whether there is some minimum value of the option, I should not compare 38 with the spot, which is irrelevant. I should compare 38 with the forward price. So first, assume, for instance, that the risk-free interest rate is 2% in continuous compounding, and let us calculate the forward price. Here I'm using to identify the forward price ST rather than F, simply because otherwise when I used F many years ago, everybody was confusing this with the future and it was a disaster. So ST is the forward price for the stock, okay? If we do not have dividends, the forward price is simply S times E power RT, okay? Usual simple cash and carry story. I purchase S, pay the interest, or at maturity I have to repay S times E power RT, which is 40 times E power 2% times 0.5, which is approximately equal to 40.40, okay? Now, if this is the case, the implication is simple. I can tell you now what is going to be the minimum value that you can lock in with this option. The strategy here would not be to exercise the option and sell spot, because this is something I cannot do. But the strategy here is to keep the option until maturity, the only thing I can do, plus sell forward at the forward price ST. If I do that, think about it. At maturity, you can lock in a minimum profit which is equal to 2.40. You can lock in a minimum profit, which is ST minus K. Why? Because you have sold the forward at 40.40, and at worst, you pay 38 to buy the stock, okay? It could give you even better, because if at maturity the stock price has dropped below 38, say at 36, you buy at 36 and you make even more, okay? But as a minimum, you have 2.40. Have I been clear? Now, there is only one extra step missing, which is the following. When you have a European option on a stock, typically when you pay the premium, upfront or at maturity, you typically pay the premium upfront, okay? So while in the case of the other option, I saw that when the option was trading 190, there was an arbitrage. Here I cannot say that if the price is below 240, there is an arbitrage, for one reason, that the premium is paid now, and this 2.40 is not made now. This 2.40 is made at maturity. Have I been clear? Because only at maturity you have a minimum profit of 2.40. So if you want to say which is the minimum boundary for the option premium, it's not ST minus K, but is ST minus K discounted. So imagine that this 240 becomes 238. It means that if the option price today quotes below 2.38, then you have an arbitrage. But if it quotes 239, there is not an arbitrage. Because you would pay 239 today, get 240 at maturity, whose present value is smaller. Okay? That's the intuition. So what I'm saying now is that the intrinsic value in my modified version for the European option would be the maximum, not of F minus K, but the discounted value of ST minus K, or 0, okay? Clearly, in the case of the put option, it would be symmetrically the maximum between the discounted value, of K minus ST or 0. I'm just inverting the two terms, okay? Nothing particularly incredible. A small remark here. Here it's important that we have two corrections. So we use the forward here, and then we discount. The forward is because the option is European, okay? And so we have to compare not with the spot price, but with the forward. The discounting is because on top of being European, as a premium paid up front, okay? I'm saying that for a simple reason. In the unlikely case you face in life a European option with a premium paid at maturity, okay? In this case, in the formula, you shouldn't discount. Because the discounting is that because you have to compare the minimum profit at maturity with the premium paid now. If the premium is paid at maturity, discounting is not needed, okay? Now, what does this imply from the point of view of the factors that are affecting the premium? So this is what we have for the American option on the future. Imagine I add with a different color what happens in the case of the European option on the stock. First element, on the elements that we have now, which is an element that did not play a role on intrinsic value and plays a role now? The interest rate first, and the second one is? The second one is time. Because the element that there is first, this extra arrow of time that also impacts intrinsic value, and it didn't impact earlier. And the second one is that the risk-free rate enters into the formula as well, okay? So these are the first two elements which are seen in 1 second. And that's it. Incidentally, minor note. In the Black-Scholes model, you typically have all these 5 factors, okay? I'm going to show you later on, when we're going to discuss the adapted version of the Black-Scholes model that you use for the American options on the future, that in that model, at the end, the interest rate disappears, so you have just 4 elements, okay? But the formal proof is going to be not today, in some of future classes. The important thing here is that you have, this is the typical structure, so for most contracts, say 99.9%, you have at least these 5, but typically you have more. Why you have more? For a simple reason. Here we had an option paying no dividends, okay? Imagine for simplicity, you have an option that pays dividends. Imagine, for instance, a continuous dividend yield. If you had an option with continuous dividend yield, how would this formula change? Answer, it would not change. But even if the formula would not change, you would actually have one more risk factor. Why? Because if you have dividends, where does the dividend yield enter in this formula? Which of these elements written here is impacted by the dividend yield? This one, the forward price. Because here, the forward price is this formula if you have no dividends. If you do have dividends, is S times e power r minus q times t. Okay? If instead you had a discrete dividend, the forward price would be S minus I times e power rt, where I is the present value of the dividend. Is that okay? So the point I'm making is, on one end, you can take this formula as the general formula of my modified intrinsic value, which is actually also the minimum value, for all the European options of any kind, which is nice. What changes is how you write the forward price, okay? That's where the different contracts differ. And this implies that any other factor that affect the forward price also become an element of the price of the option. So, of course, it can be a dividend or a continuous dividend yield if you have a stock. Imagine you have an option on a currency. A forward price of a currency depends on what? The spot exchange rate plus the 2 interest rates on the domestic and the foreign currency. Okay? So you would not have just one risk-free rate, you would have 2 risk-free rates. The intuition, I'm not discussing currency options, it's there on the book and you can read them yourself, but the intuition is that when you have currency options, it is as if the foreign interest rate plays the role of Q in the dividend yield of the stocks. The growth rate depends on the difference between the 2 yields rather than the difference between R and Q, but it's basically the same. If you are taking options on a commodity, when you have a commodity, the forward price of a commodity typically has to consider that if you make a cash and carry on a commodity, you also have to store the commodity. So you also have, you don't only have borrowing cost, you also have storage cost. I'm selling forward 2 tons of soy, I have to put the soy somewhere, possibly not in the house, and I have to pay some extra cost for that enters into the forward. So whatever enters into the forward enters in the pricing option pricing formula. Is that okay? Now, the reason why spending time on this graph is not a waste of time is to give you one intuition, which is the following. Some of the partial derivatives of the option to the different risk factors work more or less in the same way independently on the contract. And this is particularly true for the partial derivatives of the price of the underlying, which are delta and gamma, and the partial derivative of sigma, which is vega. In this case, the behavior doesn't change a lot from one contract to another one. There are minor changes, but not tremendous, okay? One which, for instance, can have a very different behavior from one contract to another one is the derivative relative to T. Because you understand that if in some contracts it's only impacting time value, in other contracts it's impacting also intrinsic value. In some contracts where it depends on the forward price and then there is discounting, T enters here and there. If you have a European option, but with premium paid at maturity, it only impacts ST and there is no discounting and the behavior is different. And as you may imagine, there are a lot of varieties among all these combined impacts of T. Is that okay? So for instance, the message I want to give you intuitively is that when you think at the derivative relative to time, and you are trading a specific contract with a specific nature, it's important to understand well how that theta works, because not necessarily the one that you've seen on the handbook on a different underline with a different contract is exactly the same, okay? It's just to give you a rough intuition that, for instance, the derivative to T can change much more than what happens to the derivative to the price or volatility. Okay, now, what have we done so far, just to position ourselves in our map of elements? Essentially, what we've done so far is we have arrived up to here discussing the components of option value and the factors affecting the option value. So which elements, price of the underlying, strike, time to maturity, sigma, interest rate, anything else impact the value. And also, we have already done one of the two relationships that you must satisfy with an option, which is the minimum value, which is my modified version of intrinsic value, okay? Now, the next step that we have to go through is giving the intuition about the put-call parity. I would just start tonight, and then we're going to finish on Thursday. But I want to give you the idea of what the put-call parity is in a more general way than how you've seen it so far, which is, again, absolutely okay in the division of work between the two semesters. So, in order to do that, I'm going to work on a numerical example, and I'm going to use this very old set of prices, actually. But the reason why I need to use this very old one is that in order to show you what I'm going to show, it's crucial to have a market in which the option market and the future market close exactly the same time sharp. If you have one market closing 1 hour after, it's impossible to see that, the same thing on the numbers. So this is very old quotes from options and futures on the Italian government bond future. And essentially, here in these two lines, you have the two prices of the June future and the September future, respectively 110.15 and 109.65. And in columns, you have the prices for call options on the June future or on the September future, put option on the June or September future. When you look here at the strike prices, I don't know why they wrote that in this way, but this, which seems 11,000, is actually 110.0. This is 110.50. This is 111. Okay, to be compared with 110.15, which was the future price. Okay, so for instance, in this market, the ATM contract here would be the 110. Not because it's exactly equal to the future, but it's the one closest, because you only have gaps of 50 cents between one strike price and the other one, okay? So this is also to say that typically you consider an at-the-money contract, if you're trading over the counter, as the contract which is trading exactly with the strike equal to the spot or forward price. If you are on a standardized market, the ATM contract is the one which is closest, okay? All right. Now, let us imagine for a second that when you made your morning meeting today to decide which trading position you wanted to take on Tuesday, February the 23rd, you all agreed that the future on the Italian government bond should have gone up. So you took a bullish position by buying a call option, okay? Let us imagine you decided to buy the call option strike 109, whose price is 2.63, okay? So what I'm going to consider now is the situation in which you buy the 109 call at a price of 263. I move on the other side here because it's easier to make drawings here. So we make a strategy in which we buy the call strike 109 at a premium of 263. Imagine we want to plot now the profit and loss, so now not the value, but the full profit and loss at maturity that we can have from this trade depending on what the future price is going to be, okay? So clearly, what would be crucial is whether at maturity the future trades over or below 109. If the future at maturity trades below 109, would I exercise the option? I won't. For a future price at maturity below 109, what would happen is that I would lose the premium. I would lose 2.63, okay? If the price at maturity were larger than 109, I would start exercising the option, so things are starting going better, and over a certain level, I would start to make money and potentially get an incredible payoff, okay? Incidentally, here we don't care, but it's pretty obvious that the break-even point is going to be 111.63, okay? But that's irrelevant, okay? Now, in this situation, so again, I buy the 109 call at 263. While you are super proud of your position, you meet with people from class 16 and you discover that actually they are super bearish today on the market. So they think your position is awful and completely wrong, okay? You typically don't care, but this time they discuss with you and they convince you. So you try to invert the position. And one thing that you add to this is that you sell the future, which of course is taking a bearish position, okay? If you sell the future, at which price do you sell the future? Of course, you sell the future at the market price. You can't sell that at the price you want. So the future trades at 110.15, okay? So we add to our position a position in which we sell the future at 110.15. Let us add a short position in the future here. So 110.15 is here. And the position of selling the future, very simply, has a P&L that works in this way. It's a line with a minus 45 degrees inclination. Sorry, 110.15 is clearly here when the result is 0. And of course makes money only if the future price drops below 110.15 at maturity, and loses money if the future price at maturity is larger, okay? Now, what I want to see with you is what is the effect of combining these two positions. So what is the combined effect of the two? Of course, my P&L would be given by the sum of the P&Ls of the two. And it is the best thing now is to distinguish what happens below 109 and over 109. First of all, below 109, you make money on the short future, okay? But at the same time, you have purchased the call option. Has it been a good idea to purchase the call option if you end up below 109? No. What is the effect? The effect is that rather than having the full profit from the future, you have minus 263 relative to any possible level of profit on the future. So essentially, you have again a line with the same slope, which is driven down by 263, which is the premium of the call option. Have I been clear? All right. Now, an important question is the following. If the future at maturity is precisely 109, exactly what is your P&L here? It's going to be the sum of what you lose on the option and what you gain on the future, okay? If the future closes at 109, how much money are you making on the future? You sold at 110.15, you buy at 109, how much money you make? You make 1.15, okay? This plus 1.15 reduces the losses of minus 263 that you make on the option. Have I been clear? The difference between the two, if I'm not mistaken, it would be minus 1.48, okay? Which is minus 263 plus 115. Is that fine? All right. What happens when I have prices greater than 109? For any extra euro of the future, I would have exactly a compensating effect. I make 1 more euro on the call because I exercise, but I have 1 euro less on the future. You have the sum of the plus 45 degrees and the minus 45 degrees going together. So what happens is that I stabilized my profit, which is an overall systematic loss of 148. What is the key point here? Look at the graph we obtained. The graph we have here is the graph of which option? The orange one. This is a put option with which strike? Which is the strike of this put? Where do I have the change of slope? 109, okay. Which is the premium that I'm implicitly paying in this put option? Is 148, okay. So the sum that I have by combining a call option and the short future is having a long put with a premium of 148, which incidentally is exactly the price of the option on the market. If this were not the case, intuitively there would be an arbitrage, okay? We are going to work more on this on Thursday, but the key intuition is the following. In real life, the idea behind the put call parity is first that you can obtain a long or a short position on the put or the call, either directly or starting by the other option and combining that with the correct forward position. And the second thing is that if in terms of premiums, the relationship between the two is unsatisfied, there is a chance of an arbitrage in which you buy the call, sell the put, or vice versa, and do the right thing on the forward side and end up with money. And we're going to discuss that better on Thursday, okay? But it was important to give the introduction today. We are going to use again this set of old prices, even if old, but work well from the teaching standpoint. Thank you.